Private markets, public angst. What's really going on? The market is at or near all-time highs, yet many alternative asset giants and traditional managers are lagging. Credit spreads look calm, but private credit stocks trade like a storm is coming. Banks report steady results, but investors remain skeptical. Today's episode connects these contradictions. By the end, you'll have a clear map of what's driving the pain in alternatives, why big banks look better, and how tokenization may quietly rewrite the financial back office. Part 1. The paradox in alternatives. Start with the headline. Several marquee alternatives firms are down double digits this year, even as the broader market climbs. These are companies that raise fresh capital every quarter, expand into new strategies, and pitch long-term secular growth. On paper, it looks great. In price, it hasn't been. Why the disconnect? First, we're in a question phase. Investors are asking whether a new credit cycle is forming. Not a crisis, but an ordinary turn where loss rates drift up from very low levels. If annual losses in private loans rise from around 1% to 2%, that's still manageable, but the phrase doubling losses rattles nerves. Second, exits in private equity have been delayed. Higher rates slowed M&A. IPO windows were mostly shut for years and only recently cracked open. That stretches the usual 8 to 10 year fund timeline into 11, 12, even 13 years. Limited partners need cash distributions. When those don't arrive on schedule, asset allocations get tight and frustration rises. Third, perception matters. Public markets see tight high-yield spreads and say credit looks fine. The same markets look at private credit managers and price in trouble. That contradiction can't persist forever. Either public credit is too complacent, or private credit is being penalized for risks the public market doesn't see, or can't easily measure in opaque non-traded loans. Part 2. Private credit's real superpower. Look deeper at private credit and you'll find an essential idea: the power of long-duration liabilities. When capital comes from insurance float or long-dated vehicles, managers can finance long-dated assets, data centers, digital infrastructure, power projects, and large corporate loans without relying on hot money. This reduces classic banking mismatches between overnight deposits and long-term loans. This is good system design. Less leverage than a bank, better match of assets and liabilities. The catch in the current tape is earnings optics. Spread income can soften when rates fall from peaks and credit spreads are tight. Growth that once looked double-digit can print mid-single digits for a period. Add headline worry about potential losses, and you get a valuation reset even if the model remains fundamentally sound. So what matters for investors? 3 checks. 1. The funding base. How stable and long-dated is it? 2. Underwriting discipline. How loans were priced, how covenants were structured, how sectors were chosen. 3. Monetization cadence. Are distributions to investors regular or slipping? Part 3. Private equity's clock problem. Private equity used to run on a reliable clock. Invest for 3 to 4 years, improve businesses for 3 to 4 years, exit in the back half of the fund. In a low-rate world with strong multiples, that clock ran fast. Today, the clock runs slower. Deals bought on ultra-low discount rates now face a higher cost of capital. Exit markets still aren't fully normal. Funds can still deliver, but the path relies more on operational improvement and less on multiple expansion. That means patience and precision matter more than ever. Part 4. Traditional asset managers under siege. Shift to traditional active managers. Decades ago, they traded at premium multiples because they enjoyed organic inflows and fat fees. Then technology arrived wearing an index. First, mutual fund indexing, then ETS. Fees fell from dozens of basis points to nearly zero for core exposures. Most active managers underperformed over long windows. Money followed price and simplicity. Net outflows from active equity funds became a drumbeat. Multiples compressed to single digits. Some firms have responded, building ETF platforms, expanding internationally, acquiring capabilities, moving into private markets, offering separately managed accounts, and launching active ETFs. The challenge is the back book, legacy funds with fee pressure and outflows. Even with smart acquisitions, it takes time for new engines to outweigh the drag. What wins here is clear product edges, scalable distribution, cost discipline, and fee structures that reflect delivered alpha rather than promised alpha. Part 5. Big banks, the cycle, and the strategy. Now the large banks. Recent earnings showed solid credit quality and resilient consumers, but strategy still separates winners from also-rans. One lesson from the last few years: duration decisions matter. Banks that parked excess deposits in long-duration securities when rates were near zero now live with lower returns until those securities roll off. Banks that stayed short can reprice quicker and defend margins. Over time, the gap narrows, but in the moment, it shows up in return on equity. Another lesson: know your core. Some banks tried consumer for diversification and pulled back. Others doubled down on asset and wealth management to lift baseline earnings. Still others are simplifying sprawling international footprints to focus on global payments, foreign exchange, and security services, businesses with high switching costs and strong moats. Across the group, investors should ask, what is the deposit mix? How quickly does funding reprice? How capital intensive are the growth targets? How much of earnings comes from cyclical trading versus durable fee pools? And crucially, are technology and operations improving, not just the income statement? Part 6. Tokenization without the hype. There's buzz about tokenization, but the practical version is simple. Most securities already settle electronically. The industry has moved from paper certificates to centralized depositories to T+1 settlement. Tokenization pushes toward real-time clearing with an immutable audit trail. The front-end experience may feel unchanged. Click, trade, done. But the back office becomes faster, safer, and cheaper. Where it gets interesting is in illiquid assets. Tokenizing cash flows from real estate rent rolls, infrastructure projects, or revenue sharing agreements can standardize ownership and streamline transfers. That could expand investor access and compress frictional costs. It also pressures business models that profit from float and slow settlement. Expect incumbents to adopt the tech where it helps and resist it where it hurts. Over a multi-year horizon, the rails get more efficient. The winners are those who integrate early and align fees with new realities. Part 7. What to watch next. Here's a practical checklist for the months ahead. For private credit and alternatives, track realized loss rates, not just anecdotes. Watch exit activity and secondary transactions for pricing signals. Compare distribution pace against historical fund vintages. Look for diversified strategies that balance corporate lending with asset-backed and infrastructure financing. For private equity, scrutinize value creation plans that rely on margin expansion, pricing power, and operational excellence rather than multiple expansion. Note dry powder levels and discipline on entry valuations. Favor managers demonstrating consistent realizations in a choppy window. For traditional asset managers, separate fee beta from true alpha. Focus on platforms with ETF scale, global distribution, and modular product design. Evaluate operating leverage. Can margins rise as flows stabilize, or are costs fixed and heavy? For banks, map the duration roll-off and the trajectory for net interest income. Assess capital-light fee businesses, payments, treasury services, and wealth. Confirm technology spending is targeted at straight-through processing, data quality, and risk controls, not just digital window dressing. For tokenization and rails, look past slogans. Identify pilots in real-world assets, custody standards, and regulator-approved workflows. Favor interoperability and clear governance over walled gardens and buzzwords. The through line in all of this is alignment. Long-duration liabilities aligned with long-duration assets. Fee structures aligned with delivered outcomes. Operating models aligned with the realities of higher rates, slower exits, and faster pipes. The market is repricing stories that were built for yesterday's conditions. That's painful if you bought the peak narrative. It's also healthy. It forces clarity about what creates durable value. If you invest in managers, demand transparency on losses, exits, and distributions. If you invest in banks, demand clarity on duration and deposit strategy. If you invest in asset managers, demand proof of edge at a fair fee. And if you invest in the rails, remember that real transformation starts in the back office long before it shows up on your phone. This episode is for informational purposes only and is not investment advice. Do your own research and consult a licensed financial advisor before making any financial decisions.